Welcome back. This is episode 146. Since April is Financial Literacy Month, and I've been on a banking kick lately, as I've been discussing the recent banking crashes of Silicon Valley Bank and Signature Bank, I'd like to talk about compound interest and how your big bank could be stopping you from benefiting from this simple financial literacy concept. But before I get into that, just a reminder that my Retirement Readiness Review on-demand course is now live. You can sign up by going to retirewithryan.com and clicking on classes, Retirement Readiness Review on Demand. And if you don't have a plan for retirement, or you're looking to plan for retirement, wondering how much you need to save for retirement, how much income you could have from retirement for your investments, Social Security, tax planning, Medicare, estate planning, and much more, then consider going to sign up for this course. And as a special benefit, as a listener, you can use the code RETIRE25 until June 1st, and you can receive a 25% discount in the cost of the course. And you also have the course for your life, so you have a lot of time as far as how you choose to go through the course. So what is compound interest? Well, compound interest is probably one of the most simple financial concepts to understand, and that is where your money grows and it earns interest, and eventually your money starts making you money, right? That's everyone's dream, right? I'm just living off my money. I'm just making money off my money. And probably a great example of this would be the magic penny, if you've heard of this before. So if I gave you the choice to give you $1 million today, wish I could give that to everybody listening, or I'd give you a magic penny that would double in value each day for 30 days. Which would you choose? Now, if you've heard this before, you might think, well, I want to take the magic penny. But if you hadn't, you'd be surprised to learn that the magic penny doubling every day for 30 days, at the end of 30 days, would be worth $5.3 million. Now, that's an extreme example because, unfortunately, there's no investment that can actually double your money every day. Another thing I wish I could give to all my listeners. But Albert Einstein called compound interest the eighth wonder of the world because of the snowballing effect that starts to happen with compounding. And with interest rates currently where they are at 4 to 5%, you could be really missing out by benefiting from compound interest just by doing something as simple as putting your money in a money market fund, in a high yield savings account, or a short-term CD. And if you have listened to episode 116, where I talked about the 7 best short-term investments to grow your money, I went into great detail about these different options. So definitely go back and listen to that. You can go to retirewithryan.com/podcast/116 to listen to it. So what does your big bank have to do with this? Well, big banks are notorious for not paying customers interest on checking or savings. And according to bankrate.com, and I'll put a link in the article, I'll put a link of this article in the show notes. The 5 largest banks in order of size are JP Morgan, Bank of America, Citigroup, Wells Fargo, and US Bancorp. And I would say that I'm guilty of using one of them. I use Bank of America, and I've used them for a long time. And I know that they don't pay me any interest on the money that I keep there. My balance goes up and down depending on the month, but I do keep a decent amount of money there, I think, and I'm usually lucky if I earn a few dollars a year from my checkings and savings account that I have there. So this is the number one reason that you should consider breaking up with your big bank if you're not getting compound interest on your checking and savings, and it's not in the range of probably at least 4%, if not higher, then you should consider either completely breaking up with your bank or at least keeping a minimum amount of money there. And despite me trying to educate all my clients about this, and even prospective clients, I'm really shocked at how many of them are keeping large amounts of money in these banks and not earning interest. And let's just say, for example, that you had an average of $50,000 that you're keeping in a big bank. If you were able to move that and earn 4% annual interest for the next year, which is very possible to do without really taking any risk, that's $2,000 of income just from making that simple move. And if interest rates stay high for a while and you can do this for a number of years, then this could just be easy money that you can earn by really making a minimal change with your banking. And your bank's not going to tell you about this, right? These banks are notorious. There's many complaints about most of these banks of different things they do, but you need to take this initiative on your own. And you can either just set up another account, again, go back to episode 116, but you could set up a brokerage account with either Charles Schwab or Fidelity. You could set up a high yield money market by going to a website like bankrate.com and looking up the money market options that are available there. Or you could also just completely terminate your bank relationship, and you could open up a brokerage account that you could use as your banking account. And you could do that with Charles Schwab, with Fidelity, possibly even with Vanguard. Or you could also open a checking account there. And so those are different things that you can do to really drastically improve how your money is working for you and to really benefit from compound interest. Reason number 2 are fees. There's lots of fees that banks charge. First of which are account fees. Sometimes banks will charge you just to have an account there. Most of these online banks aren't going to charge you to have an account there. They're probably going to charge you overdraft fees, right? Overdraft fees can really add up, especially if you have multiple overdrafts in the same period of time. If you mismanaged your balance, you didn't realize things were going to hit, and you get, let's say, 5 overdrafts at the same time, that could be hundreds of dollars in fees. And good luck getting that waived from your bank. A lot of them, too, have minimum balance fees where you have to have a minimum balance there just to have a bank account. And the list goes on. ATM fees are another one. Some of these banks have ATM fees, and so that is something as well. Some of these banks too charge you to have to get checks, right? Sometimes they'll reduce with these online banks. They can give you checks for free. If not, you can go to different websites. Like I know in the past when I've had to order checks, I'll go to Walmart. Walmart has an option on there where you can order checks, just the basic checks for like $5 for like a couple hundred checks. So fees are another big thing that you can potentially completely eliminate by using an online bank and breaking up with your big bank. So reason number 3 are features. A lot of banks, even big banks, don't have the greatest of features. Maybe you're not using online bill pay. They may not have great reporting to you when the year's over as far as tracking like your expenses. So there's a lot of additional benefits that you can get with an online bank who are generally a lot more technologically savvy with how they're established, right? They were set up maybe from the start to be convenient for you. Where a big bank had old systems, it could be very expensive for them to add this new technology, so they're going to be really slow to do that. I will tell you that, like for my account with Bank of America, I think the technology is terrible there. They don't give me a very good report at the end of the year as far as what my spending was. When I compare that to like one of my credit cards, I have a Discover card, the reporting they give there is phenomenal as far as searching transactions, seeing where my money's being spent. So there's a lot of features that you can get with using potentially an online bank, right, or more a non-big bank. Reason number 4 is convenience. When was the last time you went to your bank, right? A lot of us now, because of the ability of things we can do on our phones, right? We can deposit checks on our phones. We can pay bills on our phones. We can pay bills online. We can use other apps too, like Venmo, Cash App. There's a lot of ways that you can do banking. So the need to go into a physical bank for many people is probably almost zero. Unless you're really old school, you don't like using a phone, you don't like using a computer. So if you're not going into your bank, don't let that restrict you. If you're dealing with a bank because they're located near you, don't be constrained by that. You can use an online bank. Probably the only instance I could think of when you need to go to a physical bank is if you need a certified check. So if you're making a large purchase, like buying a car or maybe buying a home and you're trying to put like a down payment, then you're going to need a certified check. And you'd have to figure out with your online bank how you would do that. But that's like, for me personally, that's the only times I ever go into my bank, right? You can go to any ATM with many online banks. You can withdraw the money. A lot of the online brokerage firms or online banks will reimburse you for ATM fees. So that's not a concern. So there's really not a lot of reason to have a physical bank. Now, I know some banks are adding more locations, which I think is always shocking. Why would they be adding locations when many people are not even going to banks anymore? And some of these online banks may actually have a physical location that if you were in a jam, you could go to the physical location. But I don't really think there's a need to have a physical location and let that drive your banking experience. Look for ways that you can simplify your life. If you're getting checks in the mail from different payments and things, see if you can switch those to online so those get deposited right into your bank automatically to save you the hassle of going to the bank. And the last reason would be no love for longtime clients. I can say as a customer of Bank of America, maybe you've experienced this, I'm not getting any benefit the longer I do business there. I recently had to open a new business account for another LLC, and I was under the assumption that because I had other banking relationships there, those would be looked at in aggregate for this new bank account that I wanted to open. So I went to the bank, made an appointment, sit down. Come to find out, I'd have to maintain a $3,000 minimum balance. Now, this was a very small LLC account that I'm rarely ever going to use, but they were going to hit me with a $15 a month fee just to have this account. So I didn't open the account there, and it actually spurred me into making the transition away from Bank of America. So that's what I'm in the process of doing. I'm looking to do the same thing I'm telling everyone to do, because to me, it doesn't make any sense when I've got other money there, but because it's a separate tax ID number, they're not going to look at any of that other money. They're just going to look at it by tax ID number. So again, you can find an online bank that's going to allow you to open a business account if you happen to open an LLC, or that's not going to charge you anything. Now, I know I'm saying online banks. There's definitely also some credit unions, some other options out there as well that can also be a good option as far as if you want a bank that doesn't charge fees. But the other thing, back to reason number one, is are they paying you interest? And from what I've found, a lot of credit unions, even though they might not charge you an account fee, are really not paying you a lot of interest to keep your money there. So I would suggest that you really look to online banks. Some of these companies I mentioned, Charles Schwab, Fidelity, maybe even Vanguard. There's other options out there too that could really help you to earn compound interest on your money and also probably eliminate most of the banking fees that you'd have to pay. Account minimum fees, overdraft fees, and also any ATM fees. Now, the overdraft fees, that one can be tricky, but if you already have another brokerage account there at one of these institutions, or you could move your account there, it could be linked, so that way if you ever did have an overdraft, there'd be another account attached to it to prevent you from being hit with any of those overdraft fees. So I hope this episode was helpful. I hope this helps improve your financial literacy. Go out there, get your money to start compounding for you so that you're actually earning a competitive rate of interest and you're benefiting from this high interest rate environment. We're all feeling it in our wallets, where we're paying more for things. We're paying more due to inflation. Why not be able to try to benefit somewhat from that, to be able to have your conservative money earning a competitive rate of interest so you can earn a compound interest? As a reminder, if you have a question that you want to have considered for a future episode, please go to retirewithryan.com and record or type in your question, and I'll consider that for a future episode. Thanks so much. Have a great week. Look forward to talking to you next Wednesday. Take care.